These are the markets we like to invest in, and we help people invest in. So if you want to know what these markets are, you can just go to jasonhartman.com and click on the properties page, and you'll see our favorite linear markets. These are the steady, profitable markets where the prices just chug along and very reliably appreciate over time. So the government wants inflation. It benefits them. And if you are a real estate investor, you want inflation too. Not for the reasons that most people think. The amateur opinion of this, the amateur observation here that you've heard throughout your life and you're already thinking of is, well, real estate is a good hedge against inflation because it's a commodity, right? Or it's what I call packaged commodities. And those will hedge inflation because they'll keep pace with inflation or maybe even do better than inflation. They might even outperform it. But that's the kindergarten level. What I want to talk to you about today is the more advanced level and how you can benefit from this. Okay, so to understand inflation, let's distinguish the difference between real and nominal and between price and value. The word nominal means in name only. So what is the name of something? Well, what is the name of a dollar? The name hasn't changed. It's still called a dollar. It was called $1 50 years ago. The name hasn't changed. The value of it has changed, though. Inflation is the insidious hidden tax that destroys our purchasing power. It destroys the value of our savings, our stocks, our bonds, even our equity in real estate, and thankfully, the value of our debt. It destroys the value of government debt, like we just talked about, but it also destroys the value of our personal debt, which is a great thing. Inflation is the most powerful way to redistribute wealth. It's much more efficient than taxation. Inflation's much more efficient. And inflation redistributes wealth from lenders to borrowers. Think about it. If you borrow money, you borrow it in today's dollars. When you pay the money back over time, you pay it back in tomorrow's dollars. So you're effectively right there shorting the dollar because the value of the dollar goes down and you get to pay it back in cheaper dollars over time. Interestingly, inflation also transfers wealth from old people to young people. Now, most people think that wealth is transferred through inheritance, and that's certainly true. But there's another big way wealth is transferred between the generations, from old to young, and that's through inflation. Most older people, hopefully at least, have assets. They have these things above: savings, stocks, bonds, and equity in real estate. And young people typically have debt. So the debt is diminished of the young people, and the savings and stocks and bonds of the old people is also diminished. So that's literally a transfer of wealth without anybody dying and anybody inheriting anything, right? So important to know. Now, one of the things I've been saying for many years is that when the government is broke, it becomes predatory on its citizens, okay? And the government does this in many, many ways. It increases its fines, it increases taxes, it increases regulations so that more people will be forced to break those regulations and be fined for breaking them, right? It's an absolute scam, and it's really sad. So let's be aware that it's happening. They're using COVID to do it too, and this new bill that they want to do and have OSHA fine businesses, right, and all this stuff. These are just taxes. They're all just disguised taxes. Okay, it's a way for the government to be more predatory on the citizens. But of course, it's for our own good. It's always in the guise of public safety. They have a good way of pitching this stuff. They really do. Okay, so let's look at a real example. What is inflation-induced debt destruction and how can you profit from it? I'm going to take an example, a real-world example, not a theory. This is something that happened to tens of millions of people in the US, maybe over 100 million people in the US, and to hundreds of millions, if not over 1 billion around the world, okay? So in 1971, President Nixon took us off the gold standard. And that was August 15th, by the way. That anniversary just happened. It's been a little over 50 years now. So let's go to 1972 and say someone borrowed money on a mortgage to buy a home. And we know that in 1972, because it was the same time, no inflation had occurred yet. The dollar was worth $1 because nothing had happened yet. It's the same time frame. But when we go through time, let's go 12 years later to 1984. $1 was now only worth 40 cents because the dollar had lost 60% of its value in 12 short years. That is absolutely scary and staggering. Okay, it really is. Remember, inflation, just like interest, compounds. So when there's 1 year of inflation and then another and another and another, they compound on each other. So understand this has got a multiplier effect to it. Very, very important. Okay, by 2001, the dollar was now only worth 24 cents. The interest rate in 1972 on a 30-year fixed rate mortgage was 7.37%. Because of inflation, though, devaluing the debt, the real effective interest rate these millions of people paid on this mortgage, this is not a theory, it actually happened historically, was only 1.06%. Because they got a discount from 7.37%, which was the interest rate it said on their mortgage note, on their loan documents. But effectively, because of inflation-induced debt destruction, they were really only paying 1.06%. Now, interest on a mortgage is tax deductible. I mean, there are some limits, and it depends on your tax bracket. I understand all of that. But we'll just take sort of a typical example for the typical American throughout these years. After inflation and after tax deductions on the mortgage interest, they were actually paying a negative interest rate. The mortgage paid them. They got paid to borrow the money. They got paid 1.16% to keep this house for 30 years and live in it for free for 3 decades. They got paid to be there to borrow the money. Now, if this were a rental property, the return on investment would be staggering because you don't pay your own mortgage. In this case, they were paying their mortgage. But on the rental property, the tenant pays the mortgage, hopefully, and pays you a little extra every month called positive cash flow. Okay? We love it when that happens. And the property appreciates, and you get tax benefits, and the tenant pays down the mortgage for you, and all of this stuff. So it gets much better on a rental property. I'm just giving you a very simple example on an owner-occupied home. Okay, here's the summary of it. The typical house back then was about $18,000. So with 20% down, a borrower would have borrowed $14,000 and change, $14,600. Their loan docs said that they would repay almost 3 times that amount, $36,000, at 7.37%. In real dollars, after inflation attacked the value of the debt, they only paid $16,393, making their effective interest rate 1.06. And after tax benefits, they only paid $12,655 on a typical example, making their interest rate negative 1.16%. They got paid to borrow the money. It's absolutely incredible. So that's inflation-induced debt destruction. Now, I want to switch to one more thing, and I want to answer that bubble question that I posed right at the beginning of our talk today, and then we'll wrap it up. A lot of people make a lot of mistakes in life because they don't compare things properly. As human beings, we are comparison creatures. The only way we know one thing is by comparing it to another thing. And so when we value the price of something, the value of a home, a house, a rental property, we've got to compare it to something to know what it's worth. And so I created an index for this called the Hartman Comparison Index. Okay? Now, understand there are 3 major types of real estate markets around the world and in the US. There are linear markets. These are the markets we like to invest in, and we help people invest in. So if you want to know what these markets are, you can just go to jasonhartman.com and click on the properties page, and you'll see our favorite linear markets. These are the steady, profitable markets where the prices just chug along and very reliably appreciate over time. There are cyclical markets. These are the markets that if you're looking at a graph or a chart, it looks like a roller coaster, big ups and downs, okay? It's fun to ride a roller coaster, but it's not so fun when your money's on the line. So these markets are not very reliable. The interesting thing about it, though, is the cyclical markets are the ones that the news media talks about most of the time because they're interesting. They're newsworthy. There's something going on. In linear markets, they're just boring, so the media doesn't really report on them much. I mean, how often do you hear about the housing market in Indianapolis or Memphis or some of these sort of linear Florida markets like Ocala? Okay, not much, right? The markets you hear about on the news are Los Angeles, San Francisco, New York, Boston, Miami, right? These are the cyclical markets that have bad cash flow, overpriced properties, and they're very unreliable in terms of their appreciation patterns. Then in between is the hybrid market, simply between the two, okay? So most of the world is a linear market. Around the world, the cyclical markets are all the big, trophy cities we all know of, right? In the US, I named many of them already, but around the world, there are places like Paris, London, Dubai, Hong Kong, right? Those are the sort of trophy markets that you hear about. But the vast majority of the world is linear. So take a look at how this actually looks, right? This is Memphis, Tennessee. This is a market that we've helped hundreds of investors buy properties in. It's been a great market. I've owned several properties there. Love this market for just a good, consistent cash flow market. If you look at this appreciation chart over time, it's pretty linear, right? It had a little downturn here after the Great Recession, and then it really picked up. But overall, if you chart this as a line, it just kind of goes diagonally. Not too exciting, is it? That's a linear market. This is Miami. This is a cyclical market. And here, now it was pretty linear for a while, but then it became very cyclical, big ups and downs. You can't draw a diagonal line across here and have it be somewhat even, right? Not at all. This is a boring market, a linear market. This is Indianapolis, a market we've been in for many, many years. I've been recommending this market for years. I've owned many properties there myself. And Indianapolis is boring. I mean, the only exciting thing about Indianapolis is the Indy 500 race, okay? Otherwise, it's totally boring. But I love boring. Boring is what makes money. This is Los Angeles. That's where I grew up. This is a cyclical market. This is exciting. It's a roller coaster. Big ups, big downs, really ugly. Now, look, if you can time the cyclical market right, you're going to do great. But I have never met anybody that can reliably time markets, and I've been doing this a very long time. A lot of people say they can until they're wrong. So it's really like that old fable of the tortoise and the hare. One is slow and steady and consistent, and another is, I'm going to run really fast, and then I'm going to be so tired I'm going to stop and, fall over. and then I'll sleep for a while and I'll run again. But the tortoise wins the race because he's consistent. Okay, he just keeps going along. If you look at the Case-Shiller Home Price Index compared to the Consumer Price Index, we see that things get out of whack at certain points, but they usually kind of come back in line over time, okay? And the Case-Shiller Index is not a good index, in my opinion. It's actually terrible. And I don't have a lot of time to go into these indexes right now, but, Case-Shiller, there's Housing Affordability Index, which is published by the National Association of Realtors. This one is better than Case-Shiller, in my opinion, because it takes the median income and the median mortgage payment in a given market, but it does have some flaws. It doesn't account for foreign money coming into the market. It doesn't account for people in a market trading equity after they've already had highly appreciated properties. So you can have some blind spots here. Now, one index that is my second favorite, okay, is called the First American Real House Price Index, the RHPI. And what it says is that today, home prices in real terms are 26.8% lower than they were 21 years ago. Very few people would agree with that. Now, this index basically takes mortgage payment and inflation and incomes and mixes that together to come up with its answer. And I think that's pretty good. It's my second favorite index. But of course, my favorite is my own index, which is the Hartman Comparison Index, because it answers life's most important question. My listeners have actually dubbed this the Jason Hartman question because they hear me say it all the time. And that question is, compared to what? Compared to what? To know the value of anything, we've got to compare it to something else. And I don't mean comps on a house, comparing it to, 3 properties in the neighborhood. Of course, that's how real estate is mostly valued. But I'm talking about comparing it to other things in the economy. So let's do that. Let's answer the question, is real estate cheap or is it expensive? So the Hartman Comparison Index answers this question. And this is an index that we keep improving and growing. And, to get the white paper on it, we've got a new white paper coming out real soon. Get on our mailing list because we're going to email it to everybody. Just go to jasonhartman.com, or I've got a little free book I can offer as well at pandemicinvesting.com, which are a lot of these strategies adapted for the crazy world we're living in nowadays. So either jasonhartman.com or pandemicinvesting.com. Either one will get you on our list, okay? Okay, so let's compare real estate prices to gold for a moment. Now look, I'm not a gold bug. I don't think gold's anything great. Yes, I own some just as kind of an insurance policy. But what's interesting about gold is that it has been considered money by a very large percentage of the human race for thousands of years. So I think it's a good thing to compare to. It's a measuring stick, that's all. In 1970, the median house price was about $23,000. Gold was $35. It was still controlled by the government, the price back then. If you wanted to buy the median price house in 1970, you would need 646 ounces of gold. A decade later, the house price had tripled in dollars. Gold had gone up a whole lot to $653 an ounce. And you would only need 102 ounces of gold 10 years later to buy the median price house. Let's compare that to today, or let's go to more recent times. Let's look at 2010, for example. Now, most people would think that 2010 was like the best time to buy a house because we were coming out of the Great Recession, prices had not really recovered yet, it was really cheap, right? Okay, well, let's see if that's actually true. In 2010, the median price house was $224,000. Gold was almost $1,100 an ounce. If you wanted to buy the median price house 11 years ago, you would need 208 ounces of gold. Today, everybody thinks housing is super expensive. Oh my God, it's so overpriced, it's going to crash, it's a bubble, it's crazy. You only need 2 more ounces of gold today to buy the median price house. But if you look at it in dollars, because people don't compare it to other things like they should, so they've got these big blind spots, the median house price is $380,000. 11 years ago, it was only $224,000. So it's gone up a whole bunch. But has the price of the house gone up, or has the value of the dollar gone down? Both are true, but which is more true? Gold is $1,800 an ounce, and that's a good proxy for a declining dollar. It only takes 2 more ounces of gold than it did 11 years ago to buy a house today. So if you were saving for a house for the last 11 years, say you were just starting out, you wanted to buy a house. If you got your income, you got your paycheck, and you converted the excess money into gold and saved it, you would have been much better off in the last 11 years than saving it in dollars. The house got a lot more expensive in dollars, but only 2 ounces more in gold. That's nothing. You could carry that in your pocket. It wouldn't even, it wouldn't even be heavy. It's 2 ounces. It's nothing, right? Okay, so priced in gold, is real estate cheap or expensive? It's actually quite cheap. How about oil? Oil is one of the most important commodities on planet Earth. The world runs on oil. In 1970, oil was $3 a barrel. A house was $22,000. You'd need 6,700 barrels of oil to buy a house. Today, you only need 5,600 barrels of oil. So priced in oil, are houses cheap or expensive? They're cheap. They're cheaper than they were 51 years ago. Now, interestingly, when you look at this, it's sometimes they've been really cheap. In 1980, priced in oil, houses were super cheap, only 2,000 barrels of oil, okay? 10 years ago, 2,800 barrels of oil. Today, 5,600 barrels. So over the last 11 years, houses have become much more expensive in oil and in dollars, but still, over the long term, look, 1990, it's a little more expensive today, It's cheaper than it was in 2020, last year, right? So this is the point. You got to compare things to a lot of other valuable commodities. How about rice? Rice is the food supply, the base food for 2/3 of planet Earth. So priced in rice, housing is, well, it was more expensive in 1970, way more expensive in 1980, much cheaper in 1990, pretty cheap in 2000. And today, it's cheaper than it was in 2000, priced in rice. How much rice would you need to trade for a house, right? Okay, how about compared to the S&P 500 stock index? Well, we see the price of houses in dollars over the last 51 years. 51 years ago, you would need 243 shares of the S&P to buy a house. If you wanted to buy a house, you'd say to the seller, hey, I have 243 shares of the S&P. Will you trade me stocks for the house? They'd say, yes, I'll do that trade. Today, you only need 80 shares of the S&P to buy a house, the median price house. So pretty cool. Is it cheap or expensive? And I can price it any way you want. I can price it based in median income. I can price it based in copper. I can price it in haircuts. Okay, haircuts. How many haircuts do you have to trade to buy a house? Say you cut hair for a living. Well, in 1970, you'd have to cut 9,100 heads of hair. In 1980, you'd have to cut 13,000. Today, 9,600. Priced in haircuts. Housing is a little more expensive than it was 51 years ago, but it's cheaper than it was in 2020, and it's a tad more expensive than it was 11 years ago, priced in haircuts, okay? But it's not about the price, it's about the payment. That's the thing. Because most people don't buy the house for cash, they buy it based on a payment. Now, look at this, and I'm gonna wrap up here in a moment. In 1970, the median house payment, the median mortgage payment was $142, 51 years ago. Today, it's $1,170. But if you use the official inflation rate and adjust the payment with the official understated inflation rate, that is a lie, okay? It's really higher, but let's just go with the official numbers. Inflation adjusted mortgage payment today is only $169 a month. And everybody thinks, oh my gosh, these mortgage payments are so much higher than they were half a century ago. Not really, they're only a little higher. And if you used real inflation numbers, they'd be much lower. So just understand that you got to know what you're pricing it in, right? How many ounces of gold does it take to make your mortgage payment? Here it is historically. 1970, 4.1 ounces. Today, 0.7 ounces of gold. How many barrels of oil to make your monthly payment? We're not talking about buy the whole house anymore. We're just talking about each month. 42 barrels in 1970, 38 in 1990. In 2010, only 12 barrels of oil. Pretty cheap back then. Today, 16 barrels of oil. So you got to have 4 more barrels of oil to make your monthly payment today. But hey, in 11 years, that's not much inflation priced in oil, but it's cheaper in gold, right? And everybody's just measuring dollars. How about shares of the S&P? In 1970, you want to pay your monthly payment, you got to have 1.5 shares. 1980, 5.3, got expensive. Today, you only need 0.3 shares of the S&P to pay your monthly mortgage payment. How about number of hours worked? So you take the average wage of the average American. How many hours do they have to work to pay their mortgage? 1970, 41 hours. 1980, 78 hours. 1990, 83 hours. Really expensive. That was the most expensive in terms of hours worked. Started coming down. Today, 46 hours to pay your mortgage. A half a century ago, it was 41 hours. That is not bad. Okay, it's only 5 more hours a month to pay your mortgage than it was a half a century ago. So, are we in a bubble or not? That is really the question. I'll leave it to you to answer. To me, it looks like real estate is actually pretty cheap still. But in cyclical markets, I would say it's expensive. And I didn't have time to go into cyclical versus linear markets. I think in the linear markets, if we were to divide this up, you'd find that real estate is actually really, really cheap. And in the cyclical markets, like my hometown where I grew up, Los Angeles, it's pretty expensive, but it's still not as expensive as it has been at some points throughout the last half a century.